Good morning, everybody. Thank you for joining us. We're going to get started right about the top of the hour. We may give it a couple minutes for additional attendees to get on. We'll keep you updated, but we'll be close to the 10 o'clock starting time. All right, we're going to give it just a few more moments. We looks like we got some people jumping on from the lobby, and then we will get started. All right. Good morning, everybody. Thank you for joining Dunhill Insurance. My name is Josh Tipton. We're going to be talking about premium finance life insurance today. It's going to be a quick overview. I'm going to show you one case study of an actual live case that I'm working on, and we're going to kind of discuss some of the outlook on premium finance in 2026. 2024 and 2025 weren't exactly big years for premium finance, but the financial environment in the borrowing market is kind of coming back, and we are seeing more cases put across our desk. It's going to be a quick presentation this morning. We're going to try and keep it under 20 minutes, which should be fairly easy to do. And then I think I'm going to actually open it up to a Q&A via the chat feature after the presentation. So it's going to be really high level stuff. We're not going to get into, nuts and bolts of premium finance and design, so on and so forth. We're going to touch on it a little bit, again, 30,000 foot view. So with that being said, let's go ahead and get started. All right, so a lot of folks on here have kind of heard about premium finance. Some of you guys have done premium finance, you've presented it, closed some deals successfully. Some people have some misconceptions of what it may be or what it can do. It's a buzzword that is thrown around in both positive and negative manner. So just want to kind of talk to you guys about how we use premium finance, right? First and foremost, it's going to solve large insurance funding challenges without adversely affecting your clients, your high net worth clients' liquidity. Okay. It really should, in my opinion, be used for estate succession. Excuse me, it's early on the West Coast, and legacy planning. It can be and has been used for enhanced liquidity planning. I've put plenty of those together, but the primary focus of premium finance life insurance is going to be, those core: estate, succession, legacy planning, wealth transfer. It also lends itself really well for ultra high net worth clients into some advanced tax planning, right? And so, talking about tax planning, all of the large cases in our space of life insurance, permanent life insurance, and I'm talking the really large cases, they're collaborative work, right? So what you're going to find a lot in this space, guys, is that you're going to be working with CPAs, you're going to be working with the client's financial advisors, you're going to be working with their legal counsel, and probably some estate planning attorneys as well, right? So what is good about that for us? Those people all become referral sources for premium finance in the past. Every advisor that I've worked with over the last almost 20 years of doing premium finance that has brought multiple cases successfully are working with those people. And really using them for referral sources. So what do we look at when we're putting premium finance together, right? And what of these factors are kind of changing in 2026? So the first thing that we're looking at, guys, is loan interest rates. How are we structuring the plan for our clients? How are they servicing interest on the loan? So let's talk about this particular note here a little bit more in depth. So premium finance is leveraged life insurance. It is not free life insurance. So one of the things I see some of you guys that have worked with me in the past on some cases, one of the things that I am famous for telling clients in our annual review process is every dollar of interest that you service is going to come back to you exponentially. And so we have to keep that in mind. We're leveraging, we're not offering a way to not pay for insurance. Okay. So interest rate is super important. Servicing, how often, how much skin is the client going to have in the game? Another thing that I really, really look at, and I think this is often not addressed or spoken about is carrier diversification. What index strategies are available to me? How are the carriers' loans structured? Is the money going to, one, grow efficiently and then come out of the policy in an efficient manner? We can't just throw any carrier out there, put it on a premium finance presentation and expect it to work. We really have to dig in deep for product selection, index selection, and it really is going to be based off of the client's needs and the use case, which this is going to be really apparent when I show you the case study that we put together for today, because we did some interesting product and carrier choices that I think a lot of people don't look at. So collateral stress test. If your client does not have the capacity to meet the collateral needs as projected in premium finance, you're setting them up for failure. That means the case is not right sized to what their need and capability is. So when we are doing our initial presentation, we need to make sure that we're being conservative. We're probably going to show more collateral need than what is going to be required from the client, right? They need to look at what we're putting out and go, yeah, absolutely, I have the capacity to handle that. Also, liquidity. When we're talking about servicing interest, does the client have the appetite and the capacity to service interest as planned, right? These are all things that we're looking at when we're building these plans. And then probably the most important, is there a clear exit plan? Do we know that there is a probability of success? How is the client coming out of this arrangement? Are they going to be paying from outside funds, future liquidity? We often always think that, okay, the exit of premium finance is going to come from policy proceeds. That's not necessarily true. There are a lot of designs where the client is considering on selling a business in the next 10 to 15 years, and the exit strategy is the liquidation of that business asset, right? So clear, concise planning, success oriented. We are trying to get to point A, B, and C so we can accomplish D, right? So another thing I want to kind of go over with you guys today is, what's a premium finance client look like? What's our client profile? So, $10 million net worth. Okay. That is on the low end. That is the absolute opening of client qualification, right? I typically want to see a client that's got a $20 million net worth or higher, unless it's a special use case for planning on that $10 million net worth. So another thing, we want to have some discussions with our clients before we start presenting premium finance to them. What do their assets look like? Is all their money tied up in the qualified funds? If so, then they're probably not going to qualify for premium finance. That's going to be a collateral barrier. So strong, stable, non-qualified assets. From a health standpoint, I mean, we are basing this planning off of life insurance. So we want the healthiest client possible, right? We want to make sure that, or we want to have an assumption that we're going to get a standard or better health rating on this client. And then I'm looking for somebody that has the mindset of sophistication, somebody that's comfortable with leverage. I summarize the client profile by the healthy, the wealthy, and the wise, right? Do they financially qualify? Are they healthy enough for life insurance? And are they astute enough to understand leverage and the power of leverage? All right, so before we get into the case study, let's talk about how different advisors are going to be involved in the planning, presentation, and sales process of a premium finance life insurance. Okay, so let's start with the majority of you guys, insurance agents. So your goal, your role here is to team up with your general agency, your IMO, your back office, premium finance facilitator. You're here to accomplish policy design. Here to help underwrite or coordinate the underwriting, and really you're going to be the face of the insurance product to the client. Okay. Your job is not to overstep bounds. You're not going to give tax advice. You're not going to start giving trust advice. You are the expert on the life insurance portion. Okay. If you're with a facilitator or intermediary, then they are going to be the expert on the lending and borrowing arm of the planning. Okay. We want to lean on their other advisors, their trusted advisors, their financial team. Okay. Collateral sourcing, asset allocation. What is going to be the long-term impact of their liquidity? All of that should be left to their financial advisors. CPAs, they're going to handle the tax modeling. We're going to bring in estate attorneys to handle any trust work. We really need to stay in our lane of expertise. It is a collaborative effort to put these complex plans together. All right, so before we get into the case study, one of the things that we are experiencing, and I kind of alluded to it earlier in 2026, is that interest rates are on the decline. We are expecting a little bit of stabilization in the near future, and then further interest rate decline in the intermediate future. This means that premium finance is more viable for our clients. So I have personally seen about a 45% uptick in Q1 this year from Q4 of last year. Typically, that is not what we see in the space. Usually Q4 is really heavy on premium finance. Q1 is kind of dead. So everything's looking up from a volume perspective in the premium finance world. So case study. All right, this is an actual case that I'm working on right now. It was brought to me 2.5 weeks ago. We are looking at a 35-year-old male professional athlete. Estate currently is valued at about 226 million. Super high net worth individual. His asset base is growing. I was given a estate tax projection by his planning team, and I was brought in to solve the estate tax problem. The easiest way for estate tax protection is life insurance. So they looked into traditional life insurance sales and really were not interested in stroking a premium in the multi-million-dollar realm. So that's where premium finance came in. So what are we looking at with him right now? If he was to die today at 35 years old, he's got a $90 million problem. $90 million of his estate is calculated to be exposed to estate tax. When you compound that, we're looking at a liability by age 87 that's going to grow to over $165 million. So what's our solution? I put together a finance plan for $100 million of death benefit in force day one. It's going to take care of any immediate estate tax protection. There's some structuring involved. Obviously, this is going to be in an irrevocable trust. It's going to be outside of his estate. All of those things are already determined. What are we doing here? We're going to borrow roughly $2 million a year of annual premium. I got a client that's willing to contribute $1 million a year for 10 to 12 years. We're going to end up at the 15th year. In this particular example, we're going to be able to borrow from proceeds to pay off the originating loan. From that point, the policy is going to be fully owned by the trust. There's no further financial obligations. We have a peak death benefit of $104.3 million at age 82. It actually is going to exceed the estate tax liability at that age. And then all the benefits of life insurance. Okay, so the death benefit is going to pass income tax free. It's going to be going into the trust. The liability of his estate tax is covered. This is a maximizing wealth transfer plan. This is the plain vanilla bread and butter of premium finance. Oh. This is a little hard to read. It always is when we're dealing with younger people. So essentially, this is the plan that is put together. It's all the numbers. I'll send this out to everybody that's attending, but let's kind of look at what happens here. So I charted it out so it's a little bit easier for us to digest here. So we have our net death benefit, right? Is represented by our yellow line. We have our loan balance represented by our red line, and then we have our cash value that is represented by our green line here. So, essentially what this graph is going to show you is the typical premium finance bell curve, right? We are financing for a 15-year duration. We are building enough cash value to pay off the originating loan in the 15th year. You see at his age, what is that, roughly around 50, excuse me, there's zero loan balance. It's owned by his trust completely. And then from that point on, we have a cash value and a death benefit that are going to continue to grow well into his golden years, right? So effectively solved all the problems that were given to us. Now, things to kind of keep in consideration, right, when we're presenting premium finance. Early years are going to require collateral support for sure. The middle term years and we're looking at this in a totality of a 15-year segment, right? Remember, we're paying off in the 15th year. The middle years are going to represent the peak collateral exposures, right? It is going to be a traditional bell curve. It's going to start at point A, it's going to rise, hit its apex, and descend. Okay, later years, we're going to see declining collateral needs. Anything that has been posted as collateral that's in excess of the need will then begin to be released by the lender. And again, what we're looking for is after our first 15-year period is successfully managed, we're looking for self-sufficiency on the back end. We want to fund these things in a manner that once the rollout takes place, these are going to live through perpetuity and accomplish the client's goals. All right. So in this case, there's a factor that I had to work around. I had a client and an advisory team that was very risk adverse. And so what they wanted to do is look at a whole life platform. I went back and forth with the advanced market team of 2 whole life carriers and could not get a plan that penciled out using solely whole life. So what I did in this case is I used a whole life platform for 50 million of coverage. That product comes with some contractual guarantees that are going to give me a base and a stability of my overall plan. And then I coupled it with a low cost, efficient IUL for the top end growth, right? And you can see the coupling of these two products and using them for what they individually excel at created an extremely powerful plan. It literally hit every objective for the client. So let's talk about the downside of premium finance. Not necessarily the downside. Let's talk about the truth in premium finance. Okay. These are the things that every advisor needs to be very, very aware of when you are discussing a case with an intermediary or IMO or GA or carrier even. Before you discuss cases with clients, you need to be pretty well informed of what's the risk involved. Okay. So most of these loans, I would say probably at about a 90% clip, are going to be variable floating rates. So what that means is that they're going to be based on an underlying benchmark. Okay. So back in the day, everything was based on LIBOR. Now we're using SOFR. Some are using Prime. But as those underlying benchmarks move, the client's interest rates are going to move. Now, we're not talking we're on a roller coaster on a daily basis, but we are talking annually point to point, similar to the crediting built within the life insurance policies. That's how the interest rates are going to be adjusted and addressed on most loans. So we need to be very well aware of that. There is a variable that's not in our control, and that is the interest rate on the borrowing side. Okay. Policy performance is not guaranteed. Now, like I said, there are some contractual guarantees written into the whole life product that I use, but as a general statement, we need to take the word guaranteed out of our vocabulary when we are speaking about premium finance. Okay. All of us that have intimate knowledge of IULs understand how they credit, how they work, how the markets affect them. The guaranteed portion of life insurance on the IUL side is minuscule compared to what the non-guaranteed illustrations are going to produce, right? We all know this. We've all seen this, okay? We need to be aware that there may be additional collateral required, higher than what we have probably even illustrated, right? Our collateral is going to be a simple mathematical equation: outstanding loan balance minus policy values. Are that delta between the two is going to be your collateral number. Most banks are going to put like a 10 or 15% pad on that. In addition, we don't need to get into the weeds on that, but for simple purposes, outstanding loan balance, subtract your policy values, that's your collateral requirement. So what affects collateral? Policy performance, borrowing market, right? We cannot control collateral. The client has to understand that and have the capacity for additional collateral before closing a deal with you. Here's another thing too. Great thing about IUL, right? Most of the premium finance I have done in my career is based off of IUL. Why, right? Growth, low cost, flexibility. We often, when we're sitting down with clients, we're going to really highlight those buzzwords, right? Because they do exist. So what happens if we are sitting there and we are telling the client, listen, we're going to give you tax-free death benefit. There's opportunity for tax-free income on the back end. If we run into a global financial Armageddon and we're having to chip away at death benefit, we're having to take loans, we are doing everything we can to manage the success of this policy. Unfortunately, it's not going to make it. Policy lapses. We have enough growth where we're above basis. Policy lapses. We now have a taxable exposure on something that we have probably mistakenly told a client that is going to be absolutely tax-free down the road, right? So long and short of this part, let's really understand what our risk is before we go in. So again, we've already kind of looked at some of this stuff, compliance and best practices. You know, what carrier are you using? What lenders are you using? Are you showing approved marketing material? Um, are we stress testing? Are we looking at are we stress testing the interest rates? Are we stress testing on the insurance side and showing a lower performance just to really have a view of the total landscape? I would say that most facilitators across the country are not, excuse me, showing their stress tests. They are really trying to sell the shine, the sizzle, the upside. I'll tell you what, on everything I put together, I'm going to show guaranteed results and illustrated results next to each other, especially in the collateral columns, because I want the client to know that, okay, hey, listen, the probability of your guaranteed results, very low. This is what we're assuming in our illustration. Realistically, the truth in your collateral is probably going to lie somewhere in the middle. Are you comfortable with that? Yes, I am. Great. Let's move forward. Um, Document your stress tests. I have clients sign waivers of, I have them sign documents that they understand, points A, B, and C. You really want to make sure all your bases are covered on that space, right? Maintenance. This is the thing that nobody talks about. Premium finance does not succeed for a client on the sale of the plan, meaning, yes, all the advisors are paid, the insurance advisor is paid, the facilitators paid, the carriers paid. That's great. That's the starting point. That's not the ending point, guys. The success of premium finance is the annual maintenance, analyzing the moving parts. What happened this year? How much growth did we get? Why is our interest rate so high on the borrowing side? Why did we not hit our cap on the insurance side? What was the dividend that the whole life returned? Great. That is the success of premium finance. It's not year one, it's year 2 through 15. Um, so if you are doing premium finance, I encourage you, get with somebody that has been down that road, that's done the maintenance. Don't don't rely on luck or carriers or inexperienced advisors. You really need to be with somebody that has that is either an approved intermediary or facilitator from the carrier. There's a reason why we exist. There's a reason why the carriers look to us to do all the heavy lifting ongoing after the sale of the policy. Okay. And again, I want to reiterate before we close and go to the Q&A, we really want to avoid the word guarantee. It's it's really, it needs to be out of our vocabulary. I've said it before. I'll say it again. I'll die on that hill. The word guarantee in premium finance needs to be completely eliminated. All right. So this was hopefully an educational discussion intended only for licensed professionals. Um, you see it all up here. It's not a recommendation or solicitation for any carriers. Although this is a real case, I want you to view all of the materials hypothetical and for illustration purposes only. And again, if we're dealing with clients in this space, they should be consulting legal and tax advice before signing up. So with that being said, I want to open up the chat feature. Are there any questions that I may be able to quickly answer for you guys? No questions, no hands up? Dale, what are your top carriers to go to? That is a great question, and there's no answer to it, Dale. So what is the use case? Carrier selection is more than, hey, this carrier has the highest cap or this carrier has the lowest cost. Again, what is the client trying to accomplish? So for instance, if we have, if this same 35-year-old client comes to me and says, I want to build liquidity in the future, I'm not using the same carrier that I chose when they come to me and say, hey, I have an estate tax problem, right? So you carrier selection is going to be needs-based selection. So do I have a favorite carrier for death benefit play? I've got a couple of them. Do I have a favorite carrier for cash build and cash exiting a policy in an efficient manner? I have a couple of those. So great question. But again, that's going to be case based. Huh. So, all right. So Chris says, what if a client has a private pilot license? Um, so here's the answer. What's the insurance carrier say? Um, if they can get coverage with, an aviation exemption, that doesn't affect the plan in and of itself. It's not going to affect any financing. It just, are they insurable? So that kind of drops back, Chris, to the healthy, wealthy, and wise, right? So let's drill down even deeper than, the cute little slogan. Are they insurable? Right? So yeah, we can get private pilots insured is the short answer to that. Um, Mark Gardner on here. Hey, Mark, how are you? Yes, Mark, the slides are going to be sent out. Yeah, I would prefer that you don't use that to scout for an agent. I prefer that any material I put together is case-based. So yeah, this is just for agent. Okay. From David M. Explain loan payoff and where the trust takes over. So the trust doesn't actually take over, guys. The trust always owns the policy, right? So let's talk about structure. We have our policy. It's on an insured. It's owned by a trust, irrevocable in most cases. Okay. That policy is then pledged as collateral for the loan to a lender. So it's not a takeover. Once the once the loan is paid off, the trust has always owned that asset. The collateral, hold is released from the asset. So it's not necessarily a takeover, but it is a transition of a release of collateralization of the asset. Lily, have you ever had an estate attorney not like the non-guaranteed aspects of this premium financing structure? So the structure itself is not what has the non-guaranteed aspects. It is the insurance products, right? So the easy answer to that is if you have an estate attorney that's adverse to permanent insurance, they're going to also be adverse to premium financing. Um, Again, when we're talking to colleagues, the simplest explanation is usually the best one, right? So, um, the way that I approach that is, do you agree, Mr. or Mrs. Estate Planning Attorney, that your client should use life insurance to solve their need? I get that. Yes. Okay, great. Can we also agree that although that there is risk, the same risk that is inherent within the growth of a policy in a premium finance, can we also agree that financially leveraging is the most efficient way to accomplish this goal? And if both those answers are yes, Lily, we're moving forward. Will there be an extra rating premium assuming health is excellent for a private pilot? Or there's a couple different ways we can go on that, Chris. If you want to give me a call this afternoon, we can go carrier specific and really look at the overall scenario for your private pilot client. I like those specific it, puzzles to solve. I'd be more than happy to help you out this afternoon with it. I see a hand raised. Um, I see a hand raised from Dale, but I don't see a question. Yeah, there you go. Thanks, Ephraim. Yeah, Dale, please type in the chat your question. Okay, it looks like no question from Dale.
All right. Before we end this too, we're going to be doing the raffle for the box of Pro V1s as well. And Chris, I will send you an email to with our phone number and follow up with you after this webinar. And so we'll take care of that. And so I ran a random generator. Fortunately, we're having some tech issues sharing the screen, but it looks like Tate Loonsberry. You won the box of Pro V1s. So if you can, I'll send you an email and give you a call after this webinar as well. Get the best address for you, and we'll have those out to you by tomorrow.
Efren, can I get a box of Pro V1s?
Hey, so what we're doing is also, if you guys get contracted with Dunhill and you're not contracted with us, submit 3 pieces of business. We will send you 2 sleeves of Pro V1s. And then, yeah, so we're have that going. And then we also have another promotion going. If you haven't submitted any annuity business with Dunhill, if you submit, there's a range. So we have, if you submit $100,000 annuity, it gets placed and is enforced for 30 days. You'll get $100 bonus. $500,000 annuity at the same 30 days, you'll get a $500 bonus, and $1 million annuity or higher, you'll get a $1,000 bonus. This is for your first annuity business with Dunhill.
That's a nice little kick up. Awesome. I appreciate it, man. All these promos, you're kind of forcing me back into personal production.
And we're always running new promos. And so, yeah, if you guys are golfers and somebody business, we're happy to send you golf balls.
Awesome. Well, with that being said, I'd like to thank everybody for their time. Are there any final questions before we close our session?
And Dale, I'm gonna give you a call too after this to make sure we get your question answered as well.
Perfect. All right. Thank you very much, everybody, and enjoy your week. And if you have any questions, reach out to your life marketer here at Dunhill.
Thank you, everyone, for taking the time.